Good morning, folks, and welcome to Stock Charts Today. It is May the 3rd, 5:13 in the a.m. Eastern Standard Time. Let's get to me right now, the only headline that matters, and that is the conversation that has finally begun with regard to stagflation. The Federal Reserve released their statement yesterday stating that while the economy was slowing down, inflation was around their target rate. Now, their target rate was 2%. Does anybody out there believe that inflation is rising at 2%? Has anyone gone out to dinner, gone to the supermarket? Are you paying rent? Is your rent going up by only 2% a year? It's a joke. This is what the government will admit. And what's amazing is that now with wages stagnant for years now, and the Federal Reserve making every effort to increase prices. In essence, what they're saying is they want you to pay more at the supermarket for goods and services. So after years of this fiscal mismanagement, we're seeing inflation rise, we're seeing the economy slow, and now we are catching a whiff of stagflation. I am old enough to have been around during the 1970s and early 1980s when Paul Volcker came in and he had to raise interest rates up to 20% to finally crush inflation. And for those not familiar with what stagflation is stagnant growth. It doesn't even need to be recession. It doesn't need to be a contracting economy. All it needs to be is an economy where inflation is outpacing the rate of growth in the economy. Now, the question then becomes, what do you do with your money in that type of an environment? Well, you're going to hear the talking heads on CNBC. There's no other place ever than to put your money in the stock market. And why do they take that position? It's because they are long-only fund managers and they can't keep all that much in cash, maybe 5% tops. They must put it to work. So what are they going to do? They're going to come out to CNBC and say, sell your stocks? Don't buy stocks? That's not going to happen. Talk about an inherent conflict of interest. Let's get to the charts and what we should be looking at to buy and the market reaction yesterday, because it was strange. So the first chart we want to talk about is the US dollar. The dollar has been on a tear. I would argue that it has been a massive short squeeze. It was a very overcrowded trade. Yesterday, we reached a peak of 92.50. In fact, that was a resistance level. We exceeded 92.50, but we pulled back on the day. Now, initially, this is a 4-hour chart. Let's drill down to a 15-minute chart. Initially, when the Federal Reserve made their announcement, we were right here within this triangle formation, and then we broke. And I think that in hindsight, reading the Federal Reserve statement, it was the right move. Rarely do I agree with the knee-jerk reaction, but in this case here, I believe it was the right move. The algos got all caught up on the word symmetrical and what that meant in the statement. So they, again, squeezed the shorts, closing it positive on the day yesterday. But you could see that overnight, sellers have moved in and taken the dollar down some. But let's go back to that 4-hour chart. But the dollar is still holding the breakout point. So in a stagflationary environment, the last thing that we want to own are dollars. What we do want to own, and this is what I've been pounding the table on for over a year now, is build a position in gold while it's cheap. And you could see that gold, its reaction yesterday on the stagflation news was outstanding. And then sellers moved in. So I think that the markets have finally figured out that stagflation is good. These guys with the PhDs from Harvard, it takes them a little while to get the trade right, but eventually they'll get it right. So we have regained our footing on gold and are now proceeding higher this morning, as I believe is the right move to make. And I went over this last night on Market Wrap with members that I believe that this sell-off was inaccurate, incorrect, and we have, again, since recovered. Let's take a look at the price of oil. We'll look at the Brent price, 4-hour chart. So oil has petered out here a bit. We broke out here on the 18th. We've been consolidating ever since. What we're looking for is a continuation move higher. We did break out overnight, but we haven't moved out of this base. If we clear 74.13, in all probability, you're going to see a rally, probably up and through the 75.60 level. Watch out for the support level here. This support level is critical support because if it fails, we're coming all the way back down here to $70.50 per barrel. That would be a breakout point failure or a bull trap. Let's take a look at Bitcoin. Bitcoin is up on the session. It's consolidating. We are managing to hold the breakout from yesterday. So Bitcoin is looking good. Again, these are all 4-hour charts, folks. Very short-term charts. Let's go to the major averages. The S&P 500. Now, the Federal Reserve in their statement yesterday was rather dovish in terms of future rate hikes. Going into the meeting, the rumors that were floating around was that they would talk about a fourth rate hike in 2018. I never believed that. I didn't believe it the last time they were floating that rumor, and it was rebuffed. And I certainly don't believe it this time, because we're coming into election season. And if they would have forecasted an additional rate hike in 2018, you would have seen easily a 3-handle on the 10-year yield or higher. And once we clear 3.05 on the 10-year yield, it's all over. We're moving a lot higher on yields. And you would have seen the stock market roll over. The Republicans do not want a stock market in turmoil proceeding into November. At this point, they'll be lucky if we consolidate sideways, because this is a market that is weakening. Now, you may be saying, Bob, why would it weaken if they're not going to raise rates aggressively? Remember the statement yesterday, stagflation. So what does that mean? If you have inflation outpacing the GDP number, what does that do to the bottom line of companies? Their costs are accelerating, yet wages aren't rising for consumers to be able to pay higher costs. So what does that do to their margins? It squeezes them. They don't have the pricing power. Now, McDonald's, they did. They raised prices and they passed it through, but that's finite. So the S&P 500 is pressing higher this morning. We are outside this upper band of resistance. I have been warning for months now. Beware the bright green futures. We are up marginally this morning. Allow the markets to settle down. Wait and see whether or not this rally in the pre-market is for real or is it a head fake. Because time and time again, bright green futures have resulted in bearish key reversal days, so don't fall victim. The NASDAQ composite remains in a trading range. We are up about a 0.25 percentage point on the morning, but again, as with the S&P 500, don't let these thugs on Wall Street take parking space up in your head. While you probably have some horn-rimmed glasses wearing slick-backed salesman on CNBC this morning talking about how the Fed has our back. What he won't talk about is the fact that you're seeing stagflation heat up in this economy. And that will simply negate any moderation by the Federal Reserve in terms of their willingness to raise rates aggressively. That's the story they will not tell you. They want you to buy stocks. Let's leave off with the 10-year bond. Now, take note this morning. Again, this is a 4-hour chart. We are putting in higher lows on the 10-year bond. What does that mean? It means that yields are moving lower. Now, if you had a Federal Reserve that was going to be really nice bull flag formation here. We rallied, pulled back, retest. We are now seeing a continuation breakout. Back to my commentary. If the Federal Reserve was hawkish in any way in terms of their future rate hike guidance, you would see the Treasury market dropping down with yields moving higher. That's not what we're seeing. Now let's get to members' stock chart request. We're going to kick things off with Shopify. For those of you who are new to stock charts today, members' stock chart request is where I review the symbols that our members submit for me to review on video. We're going to kick things off with Shopify. Let's go to a weekly chart first. I like to get that higher level view, and honestly, I'm concerned here. I'm concerned about the entire market. I am also concerned about Shopify. Beginning with RSI, we're rolling over here. That doesn't mean go sell your shares, but we are rolling over. We have begun to hook back up on our Stokes, but ideally we get a rollover and then a double bottom setup, meaning we roll back over and then hook back up, forming a double bottom like you saw back here. It's entirely possible. The problem is that you need price action, right? So we broke down the week of March the 26th. We've been limping back up ever since. Now we have clear resistance at the 130 to 132 level. And we are at current attempting to hold on to 124.81. That's where we closed yesterday. Now, if we break down to new weekly lows and close down below this lower band of support, Shopify becomes a short. I wouldn't go shorting until that occurred. Now, if we break out above this upper band of resistance here in blue, well then Shopify becomes a buy. We're very agnostic here about the price action of Shopify. It's got a great business model, but the chart is under pressure. If it endures the storm right now and it breaks out, well then I'll buy the stock. If it breaks down below support, well then we'll short the stock. Volume this week is very high to the downside. So what we're seeing here is institutional distribution. Daily chart. Now, here's a major concern. Forget the mess back here, okay? We broke trend, ugly. What concerns me most is that we rallied, we broke out, and closed above resistance on the 30th of April. Since then, we have broken back down. We have a breakout point failure or a bull trap. Now, what we're looking for is a continuation sideways consolidation on the shares. If we break out, great, you buy the shares. If we break down, look out below for Shopify. We're putting in lower highs on Stokes. Volume for the past couple of days above average. Again, institutional distribution. You can't buy these shares right now. I would sit, watch, and wait. Square. All right, so this is a closing day basis chart. This does not reflect the after hours action yesterday. We'll go to that chart in a moment. The weekly setup here, we have a lower high. We haven't broken down to new lower lows, at least on a closing basis. We did put in a lower low intra-week versus the April low back during the week of April the 23rd. But no real clear signs of an imminent breakdown on the weekly chart. Now, the Stokes here are flashing a head and shoulders setup, but that doesn't mean anything until you break the neckline. I've seen all too many times where you have a head and shoulders setup, and then it's negated. You know, it's like one of the most commonly identified patterns, and all too many times people jump on that pattern before they get a break of the neckline and they get burned. So it means nothing to me right now until we break down daily chart. Now, on a daily basis, we've been putting in lower highs and lower lows. So this is not a stock that has been behaving well. Now, the low of April was 43.72. That's the line in the sand because that marked a breakout back in February. And if it fails, hell, we could go all the way down to $36 per share to $34 per share. So with that 43.72 in mind, let's go take a look at the pre-market activity and the after-hours action from last night. All right, so 4-hour chart. Here's the price action overnight. Not a pretty sight. The one saving grace here is that here is that 43.72 level. This won't be the most even of lines. Certainly not the most even of the lines. All right, so you get the drift. We're looking for 43.72 to hold as support. So what are the charts telling us? I like to keep things very, very simple. Here we go. Here's the high of the after-hours session last night. Here is the high of this morning. All right, so what we need to watch here is whether or not we break this lower band of support. Because if we do, in all probability, we're coming down to 43.72. I think that in the end, that's exactly what's going to happen. Why do I think that? It's because every earnings season has a theme. The theme this quarter is that companies which beat have an initial positive reaction and then they get sold off. If they have earnings that disappoint, they'll announce a big share buyback. Or even if they have earnings that are good, yet their sales are coming under pressure, like Apple, they'll announce a share buyback. Now, earnings that disappoint, well, that's a different story. They're taken out to the woodshed. So would I be a buyer on this pullback on Square? No way. I wouldn't short it yet. I would watch for 43.72. If we close down below that level, back to the end of day charts, if we break down and close below 43.72, again, you have a lot of downside room here. So the shares would be a short on a close below that level. So be really careful here with bottom fishing these shares, or so-called bottom fishing. I don't think it's going to be a bottom. I think they're going lower. Cassie Pharmaceuticals, what a great stock. Beautiful chart. Weekly chart, vastly outperforming the S&P 500. We broke out this week above this triangle formation. We're slightly off the highs of the week. Volume thus far is good. Daily chart. Stokes are hooking up. A really nice chart. I can't personally go buying it just yet, but I know many of you out there may. Here's your pivot point. Let's call it $7.60. If we retest $7.60 this morning, which I think we may, you may want to step in, buy the shares, especially if we pull back, retest the breakout point at, let's call it $6.75 to $7 per share. Put a small trade on, scratch the itch. If we break down below $6.42, I would stop out of the trade. But I think your risk reward is pretty good here, given the health of the weekly chart. Stokes are hooking up, RSI rising, a really pretty chart. Volume, certainly in your corner. The only thing I would watch for here, and I haven't checked it out, is earnings. I would not buy, I don't like to buy any stock into earnings. So just beware of earnings, especially with the pharma names. My God, watch out for earnings. one sentence can destroy a beautiful stock in their earnings release. So just be careful. BristolMyers. Let's begin with the weekly chart. We've been watching BristolMyers. We're looking for an entry point here. It never hit our price target. It came close, but no cigar. And I warned members. Let's go to the daily chart for a moment. I warned, watch out for this rally. I think it's a dead cat bounce. I believe it's going to roll over. And sure enough, we are rolling over. I think that we're going lower here. And while my price target was at $50.24 last seen back in June of 17, I think that's going to break. I have a lower price target now. I think we're going down into the 40s. Weekly chart. The weekly chart at current, this could change by Friday, admittedly. It is pointing out that we are weak on the week, no new weekly high, and that in all probability we are going to move lower. Here's that $50.24 level. I'll be discussing with members where our price target is, and right now I'm looking to short BristolMyers. So I would not be a buyer of the shares. I wouldn't short them yet, but they're very, very close. Watch out for this is back to the daily chart. Watch out for RSI. It's rolling over here. I liked it back here because that RSI at around 16. While it may not necessarily make it back down to that level, I would like to see BMY with RSI in the teens yet again. Stokes are rolling over. Now, what if I'm wrong? What if we hold support? When would I look to buy it? That's a fair statement. If we put in a higher low or we manage to even undercut the prior low here and retest $50.24 and rally off of that level, would I be a buyer? Maybe. It depends on how we close. If we close strong at the highs of the day on volume, maybe I'd scratch the itch. But when I would really get excited about putting on a trade here is if we close above $52.87. We're not ready to have that conversation yet. Right now, the path of least resistance is resuming to the downside. So I would look to short the shares rather than buy them at this point. The last chart up today is Tesla. This is an end-of-day chart. They reported earnings after hours. We'll do the same thing that we did with Square. We'll go to the after hours and pre-market activity in a moment. But first, let's take a look at a higher level view. How has Tesla been setting up? Has the market been sending us a signal that we should beware? And there's no doubt the market has been sending us a signal. We could argue that the market is rigged against a small investor, and it is. However, if you learn the charts, you can level the playing field. We have been having false breakouts and then bull traps time and time again. We're putting in lower highs and lower lows. So the market has made it clear that we are weak and getting weaker. The path of least resistance is to the downside, and that owning Tesla shares had better be a long-term investment as you weather the storm of this downtrend. Or if you're a short-term trader, I hope you stayed small, because holding shares of a company, especially like Tesla, they have a huge cash burn rate. You're holding it into earnings, and you're rolling the dice. It could work out for you big, or you could get hurt really bad. Now, unfortunately, the earnings call did not go well yesterday. I'm not sure how their earnings came out, but I know that there was a major, major problem on the earnings call. Elon Musk cut that call short, and that's a problem. So let's go to the after-hours action and the pre-market activity. Actually, before we do that, let's identify our line in the sand. We're going to use 292.63 because that would take us back down yet again below support. All right, so we have a problem here for longs. This is the after-hours activity on Tesla and the pre-market 4-hour chart. So it was crushed after hours. At current, we're trading down below that critical 292.63 level. The high of this session has been 290.28. So much as what we did with Square, we're looking to see whether or not we take out support. Now, if we fail to hold the support level, we'll come all the way back down here to the lows of April the 26th. So I wouldn't catch a falling knife here. I would be very, very cautious of buying shares of Tesla. The path of least resistance is definitely to the downside. So be careful. That's it for this morning, folks. Everybody have a profitable trading day. If you're watching this on YouTube, give me a follow there. Leave a comment if you'd like, and subscribe to my channel. Click that bell, get notified of future videos. If you're watching this on the website, We Hate Spam Too, enter your email address, and we'll send you out a couple of free trade tutorials. If you're watching this on Stocktwits, Twitter, Seeking Alpha, follow me there. Again, everybody have a profitable trading day. Be careful of this market. There is definitely a warning flag on the track. Be well.